Welcome to the 50th Annual James R. Killian Jr. Faculty Achievement Award Lecture. I'm Lily Tsai, Chair of the MIT faculty. Before we begin, I will ask that you please silence electronic devices, and I invite those at the edge of the rooms to please move toward the middle of the rows so that we may accommodate those who may be joining after the lecture begins. The James R. Killian Faculty Achievement Award was established in the spring of 1971 as a permanent tribute to Dr. James R. Killian Jr., president of MIT from 1948 to 1959, and chairman of the corporation from 1959 to 1971. The purpose of the Killian Award is to recognize and celebrate extraordinary achievement by MIT faculty members and to communicate their accomplishments to members of the Institute community. The title of Killian Lecturer is the highest honor that the MIT faculty may bestow on a colleague. It is our privilege today to be addressed by Robert Merton, the School of Management Distinguished Professor of Finance at the Sloan School of Management. Professor Merton joined the Sloan School of Management in 1970 as an assistant professor of finance, holding positions of increasing rank and ultimately serving as the J.C. Penney Professor of Management. In 1988, he joined the Harvard Business School, where he remained until 2010, at which time he rejoined the MIT faculty in his current role. The faculty on the Killian Award Committee, chaired by Professor Anna Mikusheva, noted his tremendous impact as one of the founding architects of modern finance theory. He has made important contributions in a number of areas in financial economics, but he is best known as one of the creators of the Black-Scholes-Merton option pricing theory, which laid the foundation for the development of markets for options and other derivative securities. These markets have become an integral part of the global financial system. My colleagues on the committee commended Professor Merton for his profound commitment to innovation through scientific research and to advancing pedagogy in financial economics, as well as to serving as a highly valued mentor to graduate students and junior colleagues. He is also adept at developing scientific challenges, scientific, nonpartisan, and apolitical frameworks in which to apply theory to address critical issues at the intersection of financial economics and public policy, pertaining to sovereign risk management, financial regulation of systemic risk, personal retirement planning, and university endowment management. Professor Merton's accomplishments have been recognized by numerous awards, far more than I can mention this afternoon. Of particular note is the 1997 Alfred Nobel Memorial Prize in Economic Sciences, which he shared with Myron Scholes for their pioneering work in developing the Black-Scholes-Merton option pricing theory in collaboration with the late Fisher Black. Fisher Black would have shared in the prize, but he had passed away in 1995. In addition, he has been awarded 24 honorary degrees from institutions of higher education in 9 countries across 4 continents. He is a member of the National Academy of Sciences, a fellow of the American Academy of Arts and Sciences and of the Econometric Society, and a senior fellow of the International Association of Financial Engineers, and he is a past president of the American Finance Association. Bob, will you join me at the lectern, please?
Thank you.
Robert Merton, it is my privilege to represent the MIT faculty in honoring you with the James R. Killian Jr. Faculty Achievement Award. We recognize your role in the founding of modern finance theory and your skill in developing and applying innovative techniques to resolve areas of tremendous public interest and impact.
Thank you. Thank you very much. you. Now, where am I going to put this? Just don't want to get lost. This is a great treat. Well, I'd like to thank the selection committee for having chosen me for the Killian Faculty Achievement Award, and to my MIT colleagues who nominated me. This is truly a great and singular honor to have my work recognized by this remarkable and marvelous, accomplished faculty. There's really nothing quite like that, you know, I have to say. It's humbling when I consider the past honorees who I now join. I dedicate this lecture to the memory of the great MIT economist Paul Samuelson, mentor, co-researcher, and friend. I would not be standing here if it weren't for him and so many other things. For the next 50 minutes, looks like that's what the clock tells me, I will be with you to tell you about the story of what happened here at MIT during the 1970s when a central creation of financial engineering from finance science took place. And I feel so very fortunate that I was able to take part in it. Before I tell you about the story, though, I have to make a few definitions because I'm going to be using them alike, and I want to make sure everybody's tuned into it. So here's my list. Financial engineering. Financial engineering is essentially the process of applying finance science to technology to solving problems, you know, to both implementing financial innovation and treating problems of all sorts. Options. Options is a contract that gives you the right, but not the obligation, to be able to buy an asset at a fixed price or to sell an asset at a fixed price called strike price, if I use that, on or before the expiration of that contract. There are two kinds of option contracts. Put contracts, and those are ones at which the sell side you sell, and call contracts which you buy. I will want to, where's my clicker? Excuse me. I know I have it. Yep. Okay, there we go. Having defined them, I thought I'd just tell you very quickly a little bit about them just so that we're sure we're on the page. So I mentioned put and call. The put contract, this is just at its expiration or when it's exercised. This is the payoff as a function of the stock. You don't have to memorize any of this. But what I want to show you is if you had a stock, this is your payoff of the stock, is your 45-degree line. If you add the put to it, if you put those two pictures together, what do you get? You get the stock, but with a floor at 100. It's insured stock. So what does that tell you? You started with stock, you added a put, and you end up with insured stock. So what's the put? It's insurance. Okay? But there's a different way to get to the same place. You could buy a bond, a government bond that has, there's no risk in it, or 100, and then you can buy a call with this payoff, put those two together, what do you get? Exactly the same payoff, insured stock. So what's the message for you here? Options are insurance, whether you buy a call or whether you buy a put, okay? The second thing I want to point out to you is we have in economics a thing we call the law of one price. And that says that two things that are identical in every way that's relevant in the market have to sell for the same price, okay? And the reason that makes sense is that if it didn't, and it's in the marketplace and they're identical, what could you do? You could buy the lower priced one and immediately sell the higher priced one with no risk, make money. How many times could you do it? As much as you can get away with it, right? Okay? So just as nature abhors a vacuum, financial markets doesn't support arbitrage very long. It's a fleeting thing if it ever exists. So this is probably one of the most reliable theorems in economics, okay? And I want you to remember that because part of what I'm going to be showing you is about the detail of how practical, remember we're going to be talking about engineering eventually here, this system is. So I want you to remember what that is. The other thing I can make it a little simpler for us is the following. If two things are identical, have to have the same price, then that tells us from this picture that a stock price plus the put price has to equal the call price plus the bond price. Equal price, okay? Equal value. So that'll save us some time because if we can do a call, then we obviously can do a put. All right, so I will focus on calls, but the put is the insurance, is the most intuitive insurance. All right, enough on that. Let me move forward. And I have two more definitions. I got caught up in my own discussion of the options. Derivatives. Now, I'm not talking about the sort of things that freshman MIT students learn, but derivatives are instruments, contracts, securities, whose value is determined by the price of another asset or more than one other asset. They derive their value from another asset, hence the term derivative, okay? And options are a special case of derivatives, as we will see, all right? Now, the last one is continuous time finance, okay? And that's the term of, let me put it this way, I'm a mathematical finance theorist. That seems a long way from engineering, but that's what I am, okay? And what I'm probably best known for is a group of, part of finance that's come to be called continuous time finance. I'll explain in a second. I put up here 4 of my papers. This is a collection of models and papers that I wrote, all coming under this rubric. In fact, I have a book that has the same title. And the feature of all of these models is that the markets are open 24/7, always. And you can trade in them and will trade in them whenever and all the time. Hence, continuous time. There's no discrete time here, okay? Now, when I made this assumption in all these models that I've built, that was a long time ago. I'm looking at the audience, probably most of you weren't even born. It was over 50 years ago. I made a determination, I was influenced to make that decision from looking at the stock market and watching traders and seeing how they, they keep adjusting all the time with new information. And I said, I did a little math analysis, and I said, you know what? Even the way markets were working back then, okay, it was good enough to be a good approximation to reality. All models, okay? Now, today, half a century later, I'm happy to report that, institutions anyway, can trade 24/7, 7 days a week around the world, okay? So all the time. Secondly, I will mention to you that with algorithmic trading, the latencies are measured in microseconds. So I think that's pretty close for continuous time and continuous trading. So this is an example where the real world came to the model. The model is more accurate in its description of reality than it was at the original time. So I thought that was kind of a fun thing. But in order to implement this model, I needed a special kind of mathematics, because if you could trade continuously, you want to capture the real world. That's all what you try to do with models. And if you want to trade continuously, you could easily be tricked into thinking, if I could trade continuously, there's no uncertainty because I will be able to be so fast I can get there. Well, that isn't the real world. despite the fact that you can trade a lot and very, very fast, it isn't fast enough to know what the outcome's going to be. So how do you model that? And I had to, I was looking around for this because I wasn't quite sure where I would get it. And luckily, I found the Ito stochastic calculus, which there's no reason anybody here would know what it is, but it was exactly the right mathematics to model that feature, that things were continuous in action, okay, but still, every time you made a decision, the outcome was uncertain to you. And that's the key. So if you don't mind, I've got Professor Ito. I wanted to say thank you to him today, too, for creating his mathematics that allowed me to solve these problems. Okay, so now we'll come back to the story of what happens, and it took place here at MIT, really the late 60s, early 70s. I came to Cambridge, came to MIT in 1967 to do a PhD in economics department, and I was finishing up my thesis in late 69, early 70, when Franco Modigliani, a later Nobel Prize winner and a Killian awardee, came to me and said, how would you like to join the finance group at the Sloan School here? I happily accepted. And being around, I thought I would, I'd come over and meet my new colleagues, some of who I happily see in the audience, okay? And when I went over there, I met Myron Scholes, among others. He had come from Chicago a few years before, and we started talking about work. And he told me about work he was doing with another person, Fisher Black, who was that time not an academic, on the pricing of stock options. And that intrigued me because I had worked on that in my thesis, and also I had traded them for a long time before that. And so I got engaged in it, and I said to myself, he told me what they were doing, and I decided that I could ought to look at it in the context of my model. So he showed me what he did, and I'm going to do it. This is not going to be a class, I promise you. But sometimes it's easier just to describe it. The way they thought about the model and the way they did it, they said, look, if a bank or an insurance company issues this insurance, this option, it's got a risk. It's got a liability. It's got to pay off on that. And if the thing that goes up, they're at risk that if the stock goes up with this call option, it's going to be worth more. All right? So the question is there a way to get rid of that risk? Why do they want to get rid of the risk? After all, they're in the business. The answer is that in order to assure people that they will pay them what they're promised them, they have to have capital. Capital is expensive. So if they could lay off some of the risk in the markets that's not necessary for what they're trying to do, they wouldn't have as much capital. They could save capital costs, but also they could scale themselves much bigger for the same amount of capital. Okay? I'm just trying to give you the motivation why anybody would want to do this. Now, when I looked at it, when I tried to do this, I looked at it from that perspective, and I said, how would you do that? And the answer is that since the stock, the option depends on the stock, if you did trading in the stock, you might be able to hedge and get rid of some of the risk. So let me just quickly show you what happens. Now, the problem that makes this a little more difficult, hedging is easier than other things, is the price of the option. You see this curve. We don't know what the option price is. That's what we're looking for. But we know it looks like that. You can prove that it looks like this. So the idea that it had, and this is to say, well, let's see if, let's say the stock price was 82. This is the price of the option. What if we took a position in the stock that had a slope like this tangent? Okay? Then look what happens for a very little move in the stock up. If it goes up, the bank or the insurance company loses on the option it's written. But it offsets it because the stock is going up. What if the stock goes down? Well, they lose on their stock, but they gain it on the reduction in the option that they owe. So this is just intuitively explaining to you what hedging is. It's just offsetting the risk, and you use the stock market to get that risk out of your firm. Okay? What's the challenge here? The challenge here is, look here, if we were at 54, what would that slope be? What would be the offsetting thing? You can see it's less steep. Or if we're up at 119, it's steeper. There is no fixed amount of stock that you could put in and just leave it as a hedge, set it and forget it. The only choice you would have is to keep adjusting this hedge in response to movement. So if the stock moves up a little bit, you're going to adjust the hedge, okay? And this was kind of the idea the idea roughly that Black-Scholes had when they first did it, but they were thinking of pricing this in terms of an equilibrium model. For those of you who know it, they were using the Bill Sharp's capital asset pricing model. If you've ever taken any finance, you've heard of it, okay? But the key point is they were using an equilibrium model, okay? And they arrived at their formula by thinking about, how to get rid of, and I'm going to use a little jargon here for the finance people, how to get rid of beta, and that would allow them to close the model and do it. That, if you don't know what you mean, just think of it's the thing that fixes it. What I was thinking about is, what happens if I put it into the continuous time model? Remember, where you can trade all the time, all right? And that's what I did. And guess what? In the model, you can get rid of all the risk. In other words, if you dynamically trade and keep doing this, you can show that all the risk goes away, not just some of it, not just the systematic risk, as that's, again, jargon term, all goes away. So in principle, you could get rid of all the risk. Well, what does that tell you? If the combination of the option position and what you're doing with the stock collectively gets rid of all the risk, then what does the law of one price tell you that I just mentioned to you, the strongest economic rule? It has to have the same return as the Treasury bill or whatever is the riskless rate of the side maturity, okay? Well, that closed the model. But it didn't close it because of equilibrium. It closed it because of the law of one price. So when I went back to tell Myron, I said, this was great. Your formula is correct. And then I joked with him and said, but for the wrong reason. But the reality was that since no arbitrage is a necessary condition for all equilibrium models, not the capital asset pricing model, not the Jones's equilibrium model, all models, then two things happen. One, obviously, it's more general than a particular equilibrium model, but it tells you that every equilibrium model that satisfies the other conditions posited has to give you the same price. So, of course, they got the right price from the equilibrium model. They get it from any model. So what was the impact of this? Well, the impact of this, and I better move on or we'll be here for a long time. Very quickly, when you put those into the equation and using the Ito calculus, you get a condition that has to be satisfied to avoid the violation of arbitrage. Just pointing that out. Now, if you move that equation around, you get this partial differential equation. It's a treat to be talking to a general audience, be able to put a partial differential equation on and not have you all go, oh my God. I'm not going to ask you to solve it, but I just wanted you to see it. And I did it for a reason, besides just showing you PDEs, to show you what variables and parameters enter into the pricing for this call option. And the stock price, of course, that's not surprising. The length of time till expiration, when the contract expires, this insurance contract, that's what it is, that's there, and the strike price is there, of course, and the risk-free interest rate, because remember, everything has to have that same return, all right? Those are all observables are given. But there's one more thing that you need in there, and that's the standard deviation of the return on the stock. That's the measure of the degree of volatility or uncertainty about the stock price, okay? So that's the only non-observable. But what I want to call attention to is not there, what's here, but what's not here. The hounds, the Sherlock Holmes, the dog didn't bark was the big thing. What's missing is the expected return on the stock. Seems like that'd be fairly relevant to something that pays you when it goes up and so forth. Now, why is that important? Well, the expected return, you might be looking at some stock and you look at it and you say, boy, this is a dog. It's way overpriced. Its expected return is way, way down. On the other hand, she may be looking at it and she's saying, this is great, okay? Underpriced, great, high expected return. Bear and a bull. Well, what is this telling you? As long as the two of you agree on the uncertainty, the risk, the variation around your expectation, you'll agree on the call price. And that's a powerful result. It makes it very practical because it's extremely difficult to estimate, and you don't have to be in the business of figuring out if the stock is overpriced, underpriced, or fairly priced. And you certainly don't have to assume it's fairly priced, okay? So that's why I wanted to show you this. Now, that equation has a solution for certain constant parameters, and it's the Black-Scholes-Merton equation. And I'm not going to say anything about it, but I just want you to stop and look at it, because I want you to think about this. Look at what this is telling us. It's telling us the price, right? That's the C. And then it also is telling us how the process to create this dynamic strategy, because it's giving us the rules for trading to create this. Now, if we got rid of all the risk mixing this dynamic strategy with the call, what must have been the case? That dynamic strategy in the stock exactly replicated every outcome on the option, not just on the whole, on the average, every one of them. And that's why we applied the law of one price, because they were identical. So you actually have a production process. In fact, that's what I would interpret this price. This price is not necessarily the market price. It could be. It's the production cost for a low-cost producer, somebody who can do this in trade, who can manage it very well. All right? Just like, you're building cars, you have a production cost. And then you have a production process, assembly line. That's what you've got here. This formula gives you your production cost. And the rule for trading to synthesize it, if you want it, is the proximate process. You keep moving your position in the stock all along, and if you do it right, at the end, what pops out? Exactly the payoff to the call option. And so if you think about this, this is exactly what an engineer would need to solve a problem and build an option-producing thing. They've got the cost, and they've got the process. And by the way, looking at the process, that also gives you, even if you're not making it, a way to continuously monitor how the risk is changing. Okay? The risk is changing there. You get to immediately know how the risk is changing. So what does this do? This essentially provides everything you need to produce an option. Okay? And this is the production cost. There's no assumptions of even being in equilibrium. There's no assumptions that markets are rational. All you need is the assumed process that you're going on there, but you don't have to assume that. It turns the model into a normative model of action, and that's what made it so powerful, because this tool. Now, having shown you that, let me now talk about a little bit of a problem that occurred. We had this wonderful model, wonderful price. It did all these things. It was just what every engineer needed. The only problem was there were no, in 1971, when we finished the work, actually, there was no market. There was no traded market in options. Well, that kind of limits it a little bit on using it, but you could still produce, custom ones from firms, as I've described. But what's the real problem? You have no data. You have no way to test the model. That's a completely theoretical model. How do you know whether it even works or could work? And so we were very fortunate. That's why the term serendipity. Right at that time, when we finished, they decided to build an options exchange. People wanted to create one. And, one day there was a knock on the door. It was a phone call, but to Myron and me, from Wall Street. And they said, we've heard about this model, and we're building an options exchange. We're getting ready for it. Would you guys help us out? We said, of course. Why not? It's a big kick to get this done. And by 1973, the market opened, and you had the opening of the market. They were ready to go. By 1975, 2 years in operation, this was the overwhelming model used by everyone. It completely dominated. Things were quoted that way, they still are, but they're quoted that way. So I'll stop here, take a bit of time with you, and then I'm going to speed up a little others, is that, think about this, you took something entirely in theory with no data, and within a matter of relative numbers of years, it's the dominant tool being used in a major market. You want to see how major it is, okay? Here's the history, or what I would call the history. This is the amount of trading volume on that just listed option exchanges since '73 when it opened. Now, you probably can't read that too well. I'll read it for you. Last year, when you see that thing, there were 10 billion contracts traded. That's trillions of dollars of value of the option, and many trillions of the stock. And so that's it. Okay, now, that wasn't the only thing going on in 1970, though. What else happened in the 1970s was a series of shocks hit the U.S. You can see them up there. Basically, the currencies that had been fixed for 30 years, basically to gold, the dollar, all came off the rails and started varying all over the place, trade and everything else. Nobody had thought about it for 30 years. Secondly, you had two oil crises. You have the creation of OPEC. That's a pretty disturbing to the economy. What else you had? You had double-digit inflation. Now, of course, that's not as impressive these days as we see it at the level it is. But for the last 40 years, we haven't seen anything like it. And it was really staggering. And you also had, of course, double-digit interest rates. Also something that's hard to imagine. The stock market fell 50% in real terms in 18 months. And on top of that, there was no money in the banks for mortgages. Why? Because there was a regulation that wouldn't let banks pay more than 5%. It's not rocket science if you can get 8, 9, or more % on full faith and credit governments to do that. So all of these things. And then what else that happened? We had all this high inflation. We had high unemployment at the peak, 9%. That wasn't supposed to happen. It's called stagflation. We hope it doesn't return. But we have both high employment and high inflation. So those are the shocks. What was the response? The response was an explosion of innovation, financial innovation. New institutions, new markets to deal with these new risks, okay, and new products. And I'm not going to go through them all. You can see them. In fact, there's so many big ones, creating pension funds that didn't exist for corporations. Everything went on here. That I had to give two of them, two lists. There's so many innovations of every sort, creations of everything of these new markets. So what was going on with all this innovation? This was very exciting, but what I want to report to you is these innovations could not have been done, or not done very well, without the quantitative models, data, and data analysis that was done in finance science. And so this event brought together finance science and finance practice inexorably together, linked. The top research there in finance influenced mainstreaming practice. And that's, of course, financial engineering, bringing it to practice. So financial engineering emerged in this period in the 70s in an enormous way and was created. And many things, of course, including technology, led to that development. But the option model, because of its very featured nature, has come to be used for everything, as representative of how it changed the mindset of how you use these technologies and models to do things. Now, that gets us at least to the title of my talk. I will speed it up. I won't keep you all here. But after you had all this done, and you have finance science, and now we have financial engineering emerging out of this. One thing, by the way, this work, Black-Scholes, all done at MIT, nowhere else. And this was an exciting situation for the students and for the faculty, because not only did the science shape practice, but practice back into the science. And there were just more problems to work on than then you know what to do with it. And anybody in the audience, if you can be in a field where there are more problems than you can hand to students, it was very easy. It wasn't hard to be able to help PhD students, for example. Okay, and so this was just a really, really exciting period in what was going on. Now, one of the things I wanted to point out here is generalizations of this model. Now, after all we did was price a call option on stock, and we know we've got to put to. But there was nothing special in the analysis about the asset being a stock. It could be anything. It could be a currency. It could be a cryptocurrency. There are options on Bitcoin. Okay, you could do it on commodities, interest rates, anything, inflation, anything that's a traded asset. So that's a generalization you get for free. The strike price at $100 I showed you up there doesn't have to be constant. It could be the price of another asset. So you can create contracts to exchange any asset for any other asset. In fact, you can do multi-dimensionals. You can have any asset for any other assets. You see what I mean? So if you use your mind, you can see where you can start to get pretty creative in the tools that you can create to be a financial engineer, not for kicks, but to solve problems. This is a big toolkit. It's getting much bigger. It allows you to do whatever you want. But now, the last one is there's no requirement that the payoff, remember that picture I showed you, looked like a hockey stick or something, okay, for the thing, that the payoff doesn't have to be an option at all. So if you were trying to solve a problem for someone, and you said, I need something that will pay off a function, some particular transform function of currency, stock prices, whatever. I just write the function I want for my solution. Okay? So that's just what I want. And then what do? I go back to that partial differential equation that you saw, and I put it in the boundary condition, and boom. I've got the production cost, I've got how to synthesize it, and I know how to monitor its risk constantly throughout time. That's the dream. So this generalization vastly increased the applications that one could do with it. Now, we'll go back to data, the real world. You now have derivative securities, right? Because you can have any function you want. It's just the only thing is it's condition. This is the total amount of over-the-counter OTC derivatives outstanding by different dates and notional amount. And all that means, just to think of that as the amount of assets insured. In other words, it's the total thing that you are transforming, controlling, managing the risk of. Okay? This past year, that number is over $600 trillion. It was as high as $700 trillion. This is a very big base. I mean, to frame it for you, you see that red line along the bottom there? Let's see if my pointer, there it is. See that one? That's world GDP. The entire GDP of the world is about 100 trillion. So if you have a scale, this is an enormous thing. This exploded this whole thing into the managements of risk, control, most of it in currencies and interest rate controls there. So this is where the derivatives. And by the way, when Myron was mentioned, Myron and I shared the prize in 1997, and Fisher would have too if he hadn't passed away. The citation was not for options. It was for a new method to value derivatives. It recognized that this was a generalized approach. Okay, so now where do we go from here? I've shown you all that, but now I'm going to tell you about options in just thinking, not anything technical, okay? Once you learned about options, at least besides me, I found that others look at the world differently. And options are everywhere. Okay? If you think about it, you go into the bank, you get a bank deposit, you get deposit insurance, right? What is that? Well, that says if the bank doesn't pay you, you can give your deposit to the government and they'll give you what they owe you. You get made whole. That's a put option. That says you can take your deposit and put it for the amount that's owed to you. Okay? Same thing with loan guarantees. Credit risk. If you knew nothing about credit risk, but you knew about options, What is a bond? It's credit risky. It's a risk-free bond gotten by taking the risky bond and adding a guarantee, and you take the guarantee away. What's a guarantee? We saw it's a put option. So if you understand options, immediately you have an insight on how to do, what to look at, and the structure for credit. So I'm just trying to give you a feel of how pervasive this is in terms of being able to do things. I'm not going to go through all of these. There's 2 pages. But I want to point out that it doesn't just apply to financials. And I'm glad to see my longtime colleague Stuart Myers in the audience. He coined the phrase real options. And what he meant by that is, let's look at a multi-fuel power plant. What is that? That gives you the choice of which fuel to use. You have the option. You have flexibility. Now, that has no value in a world of certainty, because if you know what the world is going to be in the future, you don't need flexibility. But in a world of uncertainty, you sure can, it has value. All right? What else? Well, I'm not going to run down the whole list here, but, drug discovery, or phased financing, or for that matter, bankruptcy, all give you the option to walk away and abandon it instead of have to take it all the way through. And, I don't know, pick modularity. Do you want your system to be an integrated system? It would be very efficient, but if you have to fix something, you have to rip it all out. So you get the option with modularity. What option gets you to do, if you think about it, it's really all about decision-making under uncertainty. An option is really the thing. What does it tell you? You say, I'm trying to decide whether I want this insurance or this protection or this flexibility. And you say, what does it cost me? Well, you saw the formula, or ones like it. You can figure out what it costs you. And then you can ask the question, is it worth it? And in some decisions it won't be, and in some cases it will. So this goes to the core of making decisions under uncertainty. That's what I want you to see. And once you see it that way, the world is always going to look like options to everything. Okay. So I'm not going to, I have to, movie sequels, James Bond or something. Do you shoot it at the time when everybody's there? Obviously, that would be cheaper and more efficient. But then, if it's a turkey and it doesn't work, you spent a lot of money shooting a lot of sequel that has no value. So you have the option to not shoot the sequel. Okay, enough of that. Well, I've talked enough about, I hope I've conveyed to you this afternoon that how this has permeated the whole world of uncertainty and thinking about it and changed it. We can take the actions in markets, we can do it, but it also takes us there. And what I wanted to do is show you an example. I at least owe you one practical real-world example. So I'm going to use from the period from the 1990s, you'll see, after the German reunification, East and West. And it was a policy to try to bring the East economically up to the West. And the city of Leipzig was in the East. And the city of Leipzig there wanted to grow to meet that. To grow, they needed more electricity. To get more electricity, they need gas. That's what they were burning. And they had 2 choices. They could run a pipeline to the European grid, pay $50 million. I know these numbers sound small. You can add another 0 if you want to get attention. That's not the point. $50 million pipeline to the European grid. Or the Russian consortium offered, if they would run a pipeline to the Russian grid, they would also provide the gas from the East. And they also said, by the way, if you do this, we'll provide you with a gas at a fixed price, MCF, per Deutschmark. So it was priced, this is pre-euro. It was done before the euro. That this way you had absolutely price stability for them. You'd say, well, hey, 50 versus 300? Well, the city mayor, the city governors were the same people that had been there when it was East, not very sophisticated, and they said there's no way our population is going to put up with having come from an economy where the price never changes in a command and control way, all right? They're going to put up with the fluctuation of not only gas, but dollar Deutschmark, because this is a dollar market in the gas, all right? So despite the fact that the pipeline was cheaper to the West, they were really considering to do the East. A bank, and I can say it's J.P. Morgan, old J.P. Morgan, prior before it merged, they got wind of this, and they had a division that was, basically it was financial engineering, but it was problem solving. As they came up, they said, well, you have two choices. We have a third one now, Leipzig, and we think you'll like it better. And that choice was very simple to understand. That's part of the solution. They said, run the pipeline to the west, build the cheaper one, buy your gas at the spot price. Anytime, though, that you pay more than the Russian deal that had promised you a fixed, X Deutschmarks per MCF, anytime you pay more, we'll rebate that up. So after the fact, you never pay more than what the Russians are giving you as a fixed price. Pretty simple to understand. But what does it also tell you? You might pay less if the spot price was lower. So you see that way. Now, JP Morgan was not going to do this for zero because there were costs. They had their costs and their profits. So the price was $125 million for 15 years of this cap. It's called a cap. It's a series of call options, but that doesn't matter. You could just see what it is. You don't have to worry about it. All right, so I made a little chart here for you. And so you can probably get to the solution just by reading it, but I'll just point it out. This is what the deal was with respect to the Russians, which they were thinking of doing with the fixed price. And then in the right column is the deal for the financially engineered one from JP Morgan, and the advantages are each there. So I'm not going to go through each of them. Why don't you just look at it? I hope you can see it up there. And you can see the advantages. You save money on the capital cost. That all went back to the city. You end up not having to, having a better deal on the price of gas, and you don't have to worry because it's, no higher than what it was there. But I also want you to see, because this is an example of financial engineering done the right way that matters and has real impact. I want you to see the other risks that are also dealt with in this contract, non-financial ones, but important. One was local political risk, okay? Think about that. We've all seen this. California, 10, 15 years ago, or maybe it's now 20, when they hedge electricity, and you end up paying twice the market price for gas or electricity, and now you have to explain it to your constituency why, when gas is being sold to everyone at this price, we're paying twice as much. You're not going to do very well with a 30-second soundbite to explain hedging, okay? So that's a real political problem. The JP Morgan solution, since you never pay more, and you never pay more than the spot price, solve that. Risk gone. Next one, contract performance. Yes, the Russians guaranteed you 15 years of gas at this price. Well, Russia even then had a good reputation for not always meeting their contractual obligations. In fact, 6 years after this contract was done, okay, and I want to make sure that you heard it was done. They did decide to do the JP Morgan, not the Russian. 6 years later, Russia defaulted on a brand new bond it issued on its first interest payment, and it was in rubles, meaning all they had to do was turn the crank and print them, and they wouldn't do it. JP Morgan, on the other hand, AAA global bank, check, contract risk. Now, that next to geopolitical security, okay? If you take the pipeline from Russia, Leipzig is vulnerable to them turning the pipeline off. And sadly, today, that's very contemporary, a front page issue, okay? But it was the N2. They're taking the gas from the west with the JP, they don't have that problem. And finally, the environment, certainly a very 2022 issue. Had they done the Russian deal, they would have built a very long, dirty pipeline. They ended up building a small, shorter pipeline. That's greener. So I'm sorry to take each one of them, but I want you to see that when you engineer it the right way, you take care of all of these, and you can see the dominance here. You also can see how simple this is for these clients. They were not sophisticated. These were people from a command and control economy background. They didn't know what present value or anything was. But it was really simple to make the decision. It was transparent. There was nothing hidden. okay? Now, what's not shown here is what it took J.P. Morgan to do this smooth, simple, easy to understand contract. It was very complicated at the time. The markets there to hedge it weren't there. They had to use surrogate markets. They had to do a lot of modeling. They had to do all, I mean, I could tell you the tax changes. I mean, endless complexity and risk. But this is the way it should be, I think, everywhere, but certainly in finance. The customer, the client here, had something simple, easy, and transparent. It did what they wanted. All the complexity that was necessary to lay this risk off was in the professional firm that did this for a living, with people who do this for a living. That's where it belongs. You can't get rid of complexity if you need it, but it belongs in the right place. And this mattered. This changed the environment. It changed this. To this day, there's an impact of this. I went through this one detail, and I purposely took an example away from today for lots of reasons, okay, because then you get into other discussion, to show you that this was this. Okay, well, now, I've shown you everything on the title of this talk, except I want to say a little bit, the last 5 minutes, if you'll permit me, about what I'm doing now in this area of engineering solutions. It was mentioned in the opening, retirement, that I'm working in retirement. And I am doing that, and we've made a lot of progress. By the way, everyone here, I assume, either has a 401k, has used a 401k, or will acquire a 401k, okay? So that's of relevance to all of us. We've done much better in solutions that have been done over the last 20 years. Really, it has improved a lot, but we have a lot more to go. And I wanted to show you two things very quickly that matter. And here's the circumstances. What is a good retirement? Quickly. A good retirement is one that you can sustain the standard of living that you enjoyed at the last part of your life for the rest of your life. I think that's pretty good. If you agree with that, what's the thing that's in there? Standard of living. How do you measure standard of living? Always. How do you measure it? Income to sustain it, not a pot of money. It's an income statement. Social Security gives you the benefits in income. The defined benefit plan here at MIT that people have tells you your benefit in terms of income. What do you see when you go to your 401k? How much money you have. So here's a hypothetical for you. You're 50 years old, you have $1 million in your 401k. That's a lot of money, right? Tell me, how are you doing on your goal to the good retirement? Most people have no clue how to do that. But I will tell you, with only this information, my smartest MIT colleagues in finance couldn't answer that either. It's not enough information. And quickly, let me tell you why. The 10-year U.S. Treasury, 15 years ago, yielded 5%. That's $50,000 a year. The 10-year U.S. Treasury 2 years ago paid 0.6%. That's $6,000 a year. The 2-year Treasury today yields about 2.3%. That's $23,000 a year. So you look at your $1 million, and it could be $50,000 or $6,000 or $23,000. You don't have a freaking clue. And if you learn nothing else from this today, I hope that's something at least you can take home. It's the income that you can get from it, not the wealth. And it's, therefore, the risk is not the risk to your wealth in your retirement account, it's the risk to your sustainable income. And those are different, okay? So that's, now, quick cure. What if when you opened your account, it showed you the amount of income in today's prices that you could get in retirement from what you have in your 401k? So it kind of looks like a Social Security benefit in that sense. Instantly, what do you know? I mean, this hypothetical here, someone's making $80,000 a year, they get this message. I think anyone here, just try it in space. You could think about that, right? 55,000, I can relate to that. And we all have to budget money, so that's something we relate to. You don't have to be financially trained. And some people say, good enough. My kids will be grown up. I don't have to save anymore in retirement. That's enough. Others would say, oh, my God, I need more. But you see how you can get to information useful for thinking about it. Not how you execute it, but what you think about it. Just from that piece of number. Okay? Now, some people will say, oh, come on. In the real world, if you get enough money, the interest rates may be higher or lower, but so what? You'll be about right. Well, this is where we look at data. That's what we typically do in science, right? This is the chart of the amount of, for a fixed amount of income that you want. Let's say, in retirement we talked about. This is what you'd have to pay for it at different dates. These are real numbers in the United States going back to 2003 for those 2 decades. Here, it was 13. Here, it was almost 26. What does that tell you? It tells you for the same amount of benefit, you could pay half as much or receive twice as much. That's not small. So income risk is the other thing. Now, let me show you one other quick one. This will be 2 minutes, and then I promise I'll quit. Sorry, I run over. And that is, suppose you decided you want a better chance to get to a good retirement. You've looked at it and you say, not so good. Well, I can tell you one thing. There's only 4 ways to improve your chances. And I'll list them. If you pick a 5th one, I'll put you up in lights, okay? But there are only 4. And the first 3, you've heard them: save more, work longer, take risk. But of course, if you take risk is the way to get there, you better have plan B, because risk is real. Don't get this idea that somehow in the long run it's not risky. It is, okay? But the last one is different. Those are all about increasing your assets so you have more. The last one says, whatever assets you have, get the most out of them without taking more risk. Be efficient. So that's a different message. And I can tell you that as a practical matter, there are really only 2 kinds of contracts that really can move the needle for people. The annuity contract, which you all know about. The pension is like an annuity. What you do is you buy an annuity, it pays you income for the rest of your life. Even if you live to be 120, as all the good books wishes, it'll pay you. But when you no longer need money, you give up all that money, whatever is left. Okay? That seems to be a pretty good deal. Money for as long as you need it, and when you don't need it, you give it up. That is one. The other one is extracting value from your house and doing it in a way that doesn't increase risk. And that has a crummy name here in the States. It's called a reverse mortgage. I like the Korean name. It's called a home pension. But whatever name it has, the function of it is that you can do that. Now, quickly to show you how this could move the needle in the real world, okay, I have a hypothetical case, $50,000 a year, that's sort of middle of the road in the US type of number. Someone with $165,000 in their DC account and their 401k, a $300,000 house, etc. Now, they retire. If they retire and do kind of the standard thing, they get Social Security, that's $19,000 for this. Plus, if they buy a bond, because they don't know how long they're going to live, they can't just pull their money out and spend it. They might run out, right? Okay? They would get 60% of their goal. That's sort of standard investing, okay, without risk. What if they instead bought an annuity instead of the bond? Now remember, you're giving up the money when you don't need it, but because you're willing to do that, you get a lot more when you do. That raises it from 60 to 77. That's a 30% increase. That's noticeable. Working middle class for anybody, but certainly working middle class people, 30% improvement. Same assets, pretty good. But now, if you get a reverse mortgage, and the feature of the reverse mortgage is different from the mortgages you know about, is that you never have to pay the principal or the interest on it as long as you live in the house. And if you're planning to live in the house for the rest of your life, that means you don't pay any principal or interest for the rest of your life. Now, it accrues, so of course it's owed, okay? But the key is it doesn't force you, the way a regular loan, to suddenly you have to make payments, so you can't make the payments, you get thrown out of the house. That's why I'm saying this is designed with that feature to it. It's very, very important because it fits the need. Now, even under today's things, you could, if you borrow, let's say, roughly half the money on the house, and you took the money and put it back into annuity, that's going to pay you for the rest of your life, right? So you're never going to run out. That's kind of a nice feeling. That's what people like pensions. Okay, you never have to worry about, that 4% rule didn't work, for example, the drawdowns and so forth. What happens when you do all of that? 36.6, 100% of the benefit, and that's what I'll quit on with you in the terms of the thing. But this is moving the needle a lot, and it's universal. In fact, it works almost everywhere in the world. You'd be amazed if you look at the countries where the biggest asset that people have at retirement is their house. They're going to need the house to live in, okay? But what they're doing is tapping the value of the house that they're not going to use. And they're doing it in a way that doesn't raise their risk. This is fun, but I want, just so this is on record, I know this is being recorded, okay? I want to underscore a well-designed version of these. And frankly, the reverse mortgage that's available out there is not so great. Now, I don't say you shouldn't use it if you could use it, but it can be vastly improved. And I've been working. That's one of my projects with my colleagues from the Golub Center. Okay. So this is anyway. This is what I'll say basically quit on. That say to you, thank you very much for your time. I apologize for running over. Those people who know me say I always do. And at this stage of my life, even if I should, I'm not going to be able to change. So I really appreciate it with you. Thank you very much.
Well, thank you so much, Bob. I think I was not expecting to come to a science and engineering talk and walk away with action items, but I think I might actually be asking for your slides. At this time, Professor Merton will be answering questions about his work and his lecture, so I'll ask people with questions to please queue up at the microphone stands in the aisles. I think we have time for a few questions if anybody wants to follow up. As you formulate your questions, I'll also take this opportunity to invite everyone to join us downstairs in lobby 13 for a reception after the question and answer session. Hi there. So yes, I think we have a question on this side.
Professor, thank you so much for the wonderful talk. You had a very long and illustrious career, both in academia and real-world financial practice. And I wonder, how did your experience in the real-world financial practices impacted the methodology as a researcher?
Oh, very good. Well, as many people at MIT, I'm hardly the only one here who gets engaged in the practicing world while being a full-time academic and a theorist at top it all. And the answer is it has much the same effect that I was describing for what happened in the 1970s, this excitement where the science affects practice. That's what I'm doing if I'm involved. I'm trying to solve problems. Okay, that's an engineering type approach. But the practice feeds back into the theory. Going back to when I mentioned the continuous time idea, the assumption that you could trade all the time 24/7. That sounds pretty weird, but from having been in the markets, I bought my first stock when I was 10, okay? So having been in the markets, I felt confident as a young person, otherwise with very little experience, to say, I can make that assumption and I can defend it as a good assumption to make to try to understand reality. I could prove that that was the case. So had I not been involved in practice, I wouldn't have known whether that's a silly assumption or a defensible one. I'm giving you as a very triple because I mentioned it, in the context. So it's been a very exciting and feedback sort of thing, and it keeps you feeling like you're in what's going on, you're aware of what's happening, and it's also a lot of fun. You know, you have changes. You have two different very kinds of things with different challenges.
Thanks. I think we have another question here.
Can you comment on, I guess, the change in the options market of the last couple of years, the involvement of retail investors in it, both in terms of, is it a good thing for the individual investors, and also is it a good thing for the system? Is it a risk to the system, or is this something that is negligible compared to kind of the broader picture?
Well, first of all, I think retail investors have actually been involved in options for a pretty long time, so it's just not maybe as big a change as it. But there are many more of the markets now and many more participations. We believe, I believe, and my colleagues I think would support that if you're talking about investing rather than entertainment, you know, don't try picking stocks. Because first of all, you can't diversify. I don't want to turn this into a lecture. There's so many reasons if it's for the purpose of investment. You know, you're trying to achieve a goal like retirement, okay? You shouldn't be messing around with individual stocks and stuff like that. Happily, the system has really done a good job of moving people at least to holding whole portfolios, ETFs and things like that, mutual funds, rather than individual stocks, which is better. So I just want to make that general statement. That applies to all these things. But yes, in terms of being able to use options if you understand them, how can you say insurance is a bad thing? You know what I mean? So the principle is the same. I don't see any big systematic risk from the retail that I see there, but you know, famous last words, right? You'll have it on record when something blows up in retirement, because that's always the case of crises. Crises are always the things that you didn't think would happen, and we're always preparing for to fix the last crisis, which is a good idea, but it's almost never the one that's the next time. So yes, you have to monitor all of these things, but I think if they're used properly, they are insurance, and I can see, you know, that's not a bad idea. And by the way, they're embedded in lots of the insurance products for retirement, where they put you these guarantees on floors, and they say, you know, you can have some upside with the market, but floor, as I showed you. So, without more specificity, I'm not sure I can go on very much more about that. Thank you.
Thanks. And last question.
Thank you, Professor Merton's very nice presentation. I just have a small question about the JP Morgan gas pipeline story. I just wonder, did it turn out well for JP Morgan? And
that's a very good question. Yeah, they did well with that. They took, as I mentioned, they took about it, but they did pretty well on it. More importantly, I think Leipzig and the gas company did well, and the people did. You know, if you solve people's problems with a better deal than they had, and you do it well, and you don't deceive them, and you're transparent, that sounds pretty good to me. And if they made a lot of money at it, that's great. But of course, they also had deals that didn't work out for them. They're taking the risk. So you have to add it all up. You can't just say, oh, look how much they made on that deal when it works out, as if you knew the future for certainty.
Right, got it. Thank you.
You're welcome.
Do we have time for another question?
Sure.
Yeah?
Well, from my point
One
of
more?
view.
Okay, great. Last question now.
Thank you, Professor. I really enjoyed hearing about the example of real options kind of gone well and being able to create value. Can you share a real-world example of where real options have kind of gone wrong or been misused in a particular context?
There are plenty of examples. I mean, but the way to think about it, the concept doesn't go wrong, okay? It's the execution. If you have the wrong model, you put the wrong numbers in, or you use the wrong model for the problem, you have the wrong model for the thing you're trying to solve, that's a prescription always for getting into trouble. And you also just can have bad luck. You know, people always think you have to explain that somehow there was a reason you should have known. And when you take risk, lots of times that's what risk is about. You do all the right things. You would do it again if you had the chance, but you lost. So, you know, I think that, you know, I was trying to think of what would be a really good example. of one. I don't have a really great one off the top of my head, but there are plenty of them where everything from doing analyses for multiple fuel power plants and then finding out that don't work or they're much more expensive to run than you do, and those then come out that way. But I don't, that's the beauty of all this. I hope that you came across when the option model from the beginning. It's just based on the fundamental principles of the way the world works scientifically in economics. It's like the second law of thermodynamics. That may someday be rejected, but that's a pretty good one, okay? Gravity and things like that. And I wanted to try to convey to you today, that's what was exciting and made this thing so powerful. That the foundations of the assumptions were so fundamental that people accepted it even when they didn't have data to support it. They didn't have to prove it with like a clinical trial. You see what I'm saying? And so most of the things that I've described to you, I'm trying to show you this enormous toolkit that was created. And I want to say also, with your question, I'm very excited I'm about finance and what it can do to help in the future. Whether it's climate change or whatever, I don't know what the solutions are going to be, but I know finance is going to be involved in an important part of the solution. And that good financial engineering can, like as I show you, do it better and how to get executed. Okay? So, that's why I'm still here. It's an exciting subject to see things that get done. And I hope you can get a sense of the difference between, sort of ad hoc models or models that are sort of consistent with the theory of economics, but they require inputs like preferences, expected returns, that you can't observe and you really can't estimate. So they're kind of limited. Okay? Thank you.
Thank you.
Thank you.
Thank you very much. Thank you. Thank you.
Thank you, Robert, for bringing financial economics or financial science and engineering to life, and congratulations again.
Thank you.
Again, I hope you'll join us for a reception, and that was wonderful. Thank you.
Well, thank you very much. Thank you all.